Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Marathon Oil. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Well, today we have a choppy market. We are seeing the S&P 500 index is down just a fraction, and we do got the VIX index up just a bit. Not going to spend too much time on it because there's really not much that's very exciting inside the SPX chart. But we are finally starting to get our ducks in a row a little bit. We have the 200-day moving average, and here we have the 20-day moving average, and we have the 50-day moving average. So we finally see the 20-day break up above the 50, not quite to the 200 yet. The 200 was definitely an area of resistance to the upside, provided took a little bit of time to break through. We had a solid breakout to the upside in the S&P 500 index, and now we're back to the chop. We have fairly decent volatility right around that 20% level as far as the VIX is concerned, but the SPX just doesn't quite know where to go. And we do have a Fed meeting this week that should provide make the markets a little bit more interesting. And I think a lot of people are just kind of waiting to hear what the Fed is saying, not necessarily about the rate hike that's probably coming here this week, but about how fast and how quickly they think that they're going to be raising interest rates going into the year if inflation stays at this level. So we've had volatile times as far as the marketplace is concerned, and not really going anywhere. We have the NASDAQ, the SPX, even the Russell 2000 on its days has had some very good days. It always has a tendency to give a good chunk of it back, but this is the best rally, obviously, that we've had since back in March, in the middle of March. Solid rally, back to the chop again. So if I look at my VIX watch list, a couple of things that are of interest is, first of all, the interest rate, the 10-year. We see that at 2.5%. This is the SIBO interest rate index. We just got to move the decimal over. So the 10-year is near highs that we haven't seen in many, many years. And we do have oil down just a fraction today, but we're still seeing a barrel of oil trading at around 102.85 right now on the futures contract. And we see the VIX once again up above that 20% level. So as far as the VIX is concerned, we're actually in the lower end of the range, trading right around its 200-day moving average. So in my mind, the VIX is always a mean reverting index. And if it's below its 200-day moving average, I actually feel like, as far as the marketplace is concerned, it's a little bit low volatility relative to where it's been recently. So kind of interesting to see that, considering everything that we have on the geopolitical side of things, the fact that we have such high inflation. One good news, I guess, that goes along with the high inflation is that we had some really good jobs numbers recently, and that is a driver of inflation, but that also means that people are working and they have money to be able to purchase things, hopefully, if they're not too high in price. So that's all I'm going to really say about the markets. Because of the inflationary aspect and the threat to energy companies and the geopolitical concerns, we haven't talked about an energy stock in a while. The last time we talked about one, we looked at back on January 18th of this year. We talked about MRO, and we talked about a fear of missing out trade. So today, we're going to actually go revisit that trade for the first time in actually maybe ever on the Stock Play of the Day. We're going to go back and look at an old trade, see how it performed, and how we might deal with that trade going forward. So this will kind of be a little bit of a new theme, and we're going to do that. We did a lot of fear of missing out trades where we bought deeper in the money option contracts going out further in time. And it was a way to manage our risk, but also get the potential upside. We're doing it as a surrogate for the underlying stock. So let me go look at MRO and the chart on it. And we see right now that MRO is at 25.11. I'm going to go back to January 18th, 19th actually is when we looked at this trade. And on that day, well, 18th it was. So on that day, as soon as we basically got done with the show, MRO kind of got beaten up. We were right around the 20, just shy of 20 as far as the stock. Well, we can see what the high of the day was on the 18th. The high was 20.01, and the close was 19.43. So the stock dropped precipitously the next couple of days, all the way down to about the 17 and a half level. And then we've had a strong rally. So as far as our system was concerned of buying deeper in the money option contracts, unless it came down to our strike, we would stay in that position. And the trade that we looked at on that day was buying the 16th strike call option that went out to July 15th. So by our rule, we came very, very close to wanting to get out. And that the low point here, if I look, this was actually a green bar, so it ended up being an up day. We closed at the high of 1840, but the low got down to $17. And our rule has always been, and this is just a general rule, a general concept, that if we're buying longer term options that are deeper in the money, they usually have a high delta. That means they act a lot like the stock. That if it ever comes down to our strike price, we want to consider getting out of the trade, especially if it comes down relatively quickly, which you couldn't get more quickly than about 3 or 4 days after we looked at this trade. And we actually reviewed the trade in the stock play of the day overtime. So that would have been on that Friday. Okay, so with that said, we shouldn't have gotten out because it didn't ever get to our strike. And then you had a very strong update from there. And then it's obviously just basically gone straight up, came all the way back down to its 50-day moving average. That looks like it provided a little bit of support on the downside. And now we're up around the 25 level, set a recent high in Marathon Oil, around 25.76. You see where that point was. Now there's a little bit of chop in the marketplace. So how might I trade this? We're going to get a little bit long the energy. And now, as always, nothing's meant to be a recommendation here on stock play of the day. But I want to look at, okay, we have a gain on a stock. It was a little nerve-wracking to start with, but we accomplished our goal. We were thinking about getting long energy, and we wanted to get in that space for a low-cost dollar amount. Now, the stock was at around $19. Buying 100 shares of it was feasible, where we went out and actually reduced the cost from that. We looked at buying that deep in the money option contract that was $4.50. So we're talking about $450 for one option contract. And the concept was that if you planned on buying 100 shares of MRO, we're going to manage our risk by something that's similar, gives you a lot of stock price representation, but does not have the downside risk. So we accomplished that by buying one call option because we were thinking about buying 100 shares of MRO. And if we were thinking about buying 200 shares, we would have bought two call options, et cetera, et cetera. Now, stock is up. We actually talked about if it doubles, that's when I would think about getting out, mainly because you still have an option. It acts a lot like the stock, but you still own an option that has an expiration date. So we need to do something with that trade. So hence the reason I was thinking about energy stocks. Oil had a big run up all the way up to 128 a barrel. Now it's back down to 102. Still have those inflationary concerns. We still have the geopolitical concerns that are happening. So let's stick with a solid company. MRO trades right around 12 times earnings. So it's definitely not overpriced. So how would we adjust this trade? Let's pretend that we were in this trade. What would I look at doing right now? Since we have some chop in the marketplace, if I were to remain long that call option, I would think about selling a call against that position. If I didn't decide to just sell it and get out, I would turn this trade into a fig leaf. We have a lot of time going back, still left, going out to July 15th. but I would strongly consider looking at selling a shorter term option against it and bringing in some premium. Now, let's go to the option chain here real quick, and I just want to kind of highlight on even the shorter term expiration. So let's go out 17 days. We have high implied volatility, and we had high implied volatility when we were looking at MRO. I should mention that earnings are coming up here shortly too. We're going to be kicking off earnings season soon, so always keep that in mind. But if we look at the April 22nd, 17 days to expiration, we go out to the 27 strike here, and that's trading at 48% implied volatility. So you're getting a lot of juice for that. And our if I was considering staying in it, I would look at maybe selling this option or maybe selling the 2650. Depends upon, we're breaking out, trying to break out to a new high, but the stock is stalled a little bit. I usually sacrifice premium to go out further in strike when I'm just trading this against an option position. And the main reason why is I really don't want to be assigned. If I own the stock, I don't mind that. I have the 100 shares taken away from me. But if you own the option, that's where we came up with the name the fig leaf. You're kind of covered. You don't own the stock, but you own something that looks like the stock, but you're going to have to do something if you got assigned. So this would be the option that I would be looking at to sell against the position if I was going to stay in it. Now, here is the actual position. If we bought that option contract back on the 18th, we paid about $450 for it, and hence the reason why we're talking about it today is that it has doubled. It's trading right around $9.35. Still really solid markets, even on a deeper in the money option contract in MRO, and that's one of the reasons why we like MRO. In option trading, you need to have liquid markets in order to get decent prices on your option contract. And believe it or not, 10 cents wide on a 95 delta option, because we picked up some deltas because we're deeper in the money now, is a real good market. It's not as good as the stock, which is a penny wide, but 10 cents is pretty solid in the options marketplace. Okay, so if I were to sell it and I still wanted to stay in, we're a little bit more risky because we're at all-time highs, but if we break out, that's a good thing, right? If we can set new highs and break out on MRO to the upside. So now to me, it's more of a speculative play. We were looking at the energy space in general back in January. And so now I'd turn it into a swing trade. I would sell this, take my profit. I did double. That's usually my goal when I'm looking at a FOMO trade or a fear of missing out. I don't mind hanging around a little bit longer. If I did, I would sell the call against that position, a little bit shorter term, try to eat away some of the time decay that always occurs in option contracts. So that would be my goal. And if not, I would look to sell this option contract. So we're just going to clear that out, get rid of it, and take the profits. And I'm going to go out a little bit further than this expiration, which right here is 17 days out. We're going to pay attention to the earnings date, which is 5/4. So I'm going to avoid earnings. I don't want to necessarily be in it for the earnings. So we're going to do this before that May expiration. And I'm going to do the April 29th expiration. And now I'm basically looking at doing a swing trade. 24 days. We're going to buy something a little bit in the money, sell something a little bit out of the money. And we're going to pay attention to the time premium that we're buying and that we're selling. So we're hoping for a breakout to the upside. We're going to go look at the 24 strike call option in that expiration, and we're going to do a long call spread. We're going to buy the 24. Hopefully we'll get to breakout, and we're still targeting that 27 area on the upside. And it's not that the chart is saying that we should look at the 27 area. We're in a period of chop. We really want to try to break out to the upside. But we've had some profits. We're going to take a little bit of it. We still think we got some potential, and we're going to look at rolling it into a long call spread. So to me, this is the reason why we do the stock play of the day. Inside the options playbook, the book that I've authored, there are over 40 different plays. And I always want to try to look at scenarios where I can work in different plays based off of what I'm seeing in the marketplace. We had that upside. It was a little bit of a lower price stock. It was a decent a decent vehicle, investment vehicle, to look at buying a deeper in the money option contract because we had liquid markets. And now we have high volatility and we're at all-time highs in the stock. So now we're going to switch it up, and we'll look at a long call spread inside. Well, I'll pull it up in the options playbook. Let's actually pull that up. We started at the long call, so that's why I had that one up. And we're going to go to here and look at a long call spread. So now we're going to go from the long call where we had unlimited upside, and we're going to now look at a long call spread where we're going to limit our downside by bringing in some premium from selling cash. But we're also going to have limited and known upside on this underlying, but we're doing it on a much shorter term basis. So going back to the Ally Invest option chains, now that you've seen the long call spread in the options playbook, I'm going to focus on the fact that if I buy the 24 strike, we're avoiding earnings, right? If I buy the 24 strike, if I look over on the put side, the bid and ask on the put, this is the put, this is the call. I see the put is trading for about 75 to 79 cents. That gives me an indication of the time premium. Now I can do the math on it, but it's not necessarily, I don't need to be exact. The reason why I'm drawing your attention to this is that if I look at the 27 strike call that we're selling, it's selling, let's call it at the midpoint, right around 60 cents. So I'm paying attention to the amount of time premium I'm buying and the amount of time premium that I'm selling. And part of that reason why is I really just want to participate in the stock price movement. Time premium is the biggest thing that makes options different than stocks as far as pricing is concerned. If I can set up my spread where I pay almost as much, or well, it looks in this case, a little bit more time premium than I'm selling, well, then that means I'm really just participating in the stock price movement. But I'm only doing it between the strikes, between 24 and 27. Time decay and fluctuations in implied volatility, all those are not a big concern to me because I've changed up and I'm buying the same amount of time as I'm selling. Now, if we go in and we buy the 25 strike, well, now time premium is an issue because I would be paying, if I bought the 25 strike, I'd be paying less for the trade overall, but most of it would be time premium. I'm be paying, let's call it 120 worth of time premium, and I'm only bringing in 60 cents. So I'm only paying for half of it. I'm only receiving half of the time premium that I'm actually paying. So time decay would be an issue in that trade where it's not going to be in the one that we're talking about here. If you have any questions about that, because that is a kind of a tough concept, if this is your first time thinking about a long call spread, please put them in the chat box. I'm going to try to address as many of these questions as I possibly can. We want to make the stock play of the day as interactive as possible, and hopefully you will share it on social media and just let people know about it. This is free for everybody to join. We're trying to give information. We're trying to learn from the options playbook how to apply the 40 different strategies that are inside the playbook. Okay, back to the trade. We have our workbench up in the Ally Invest option chains. And so we come down to where we got a decent risk reward. The maximum that a long call spread can trade for is the width between the strikes. So that's $3. Right now, we have $1.36 at the midpoint. So if it was $1.50 and it was $3, we'd look at paying $1.50 to make $3. So the maximum you could lose is the max equal to the maximum you can make. We're a little bit better than that. So we're looking at 165 is our potential upside, and 135 would be our maximum downside. So I like that risk reward ratio. And to get something like that, you got to pay attention to your time premium and how much of it you're buying and how much of it that you're selling. So if I click trade, it's going to go on the right rail. It's going to be an official paper trade for the week. We're buying to open the April 29th expiration, 24 strike call, selling to open the April 29th expiration, 27 strike call. We'll try to work it at the midpoint. You're never guaranteed a midpoint fill, but in option trading, we never enter anything at the market, especially if you're looking at long call spreads, mainly because spreads are wider in the options marketplace than they are on the stock. So if we're looking at spreads or any multiple leg trade, we're going to always try to work at somewhere close to the midpoint and then adjust the trade accordingly. So $135, $134 plus commission would be the cost to do every 1-by-1 spread. We're just looking at one contract here today. So $134 plus commission, and that's our max risk. Okay. So I'm going to scroll down. I'm going to bring up the profit and loss graph, talk a little bit about the nuances of time premium and how you want long call spreads to work. But if you have any questions, please put them in the chat box. I see a few questions in here, so I'll address those in just a tad bit. One of the things about a time spread is, of a long call spread, is that you are selling an option contract that wants the market to go down, but you're buying an option contract that wants the market to go up. So they fight each other, and they fight each other harder in the beginning than they do at the end. And that's shown by this color line here in the Ally Invest profit and loss graph. So the dotted line is at expiration, and that's what we show here in the options playbook. But because we have technology, we can also try to make a guesstimate as to where the prices would be at different price points in different periods of time. And hence, we could say that this is a what if type calculator that we call the profit and loss calculator. So the colored line shows you if we did get to 27 right away, we don't make as much as if it happens closer to the expiration date, about 23, 24 days to go. So if I change the days to go and I take it all the way down, let's go all the way down to 3 days to go to expiration. Now you're going to see the whole line move. The whole line is shifting. So now we look much, much closer. So we're better to be correct on our forecast or where we want the stock to go closer to the expiration date than right away. So the opposite is also true, that if we're going to be wrong, we want to be wrong right away so we can get out of the trade and we can have the time premium still available to help us out and protect us. Okay. So I see quite a few good questions in here. So let me run over the Q&A box. And first one, Mohammed is saying good afternoon. I agree with that. It is a good afternoon. Second one that we have here, what are your thoughts on dividends? Okay, so MRO, I think, has a dividend, a decent dividend. Not that big, but it does have a dividend. And if a stock pays a dividend, you have to realize that it's baked into the option prices. So a lot of people will say, well, I don't want to buy calls on stocks that pay big dividends because you don't own the stock and you don't get the dividend. But understand that if a stock does pay a dividend, the call prices are going to be lesser on the same strike line than the put prices. And why is that? Well, the dividend is going to get paid, and when it gets paid, the stock goes down. Marketplace knows that, and they put it in their pricing model. So keep that in mind, that if a stock does pay a dividend, you don't get the benefit of owning the stock, but your call option that you're looking to buy is going to be at a lower price than it would be on a stock that didn't pay a dividend. Okay. So my thoughts on dividends. Well, in this marketplace, you might be buying some of the energy companies. Well, what's actually done really well recently are the utility companies. They're high dividend paying stocks, and they've had a lot of growth. They've done very well here in 2022, and they're one of the market leaders. I think I heard today that some of the only stocks that have hit new all-time highs have been some of the actual energy companies, not the oil companies, the actual companies that are providing energy. So those are high dividend stocks, and they've done well. A lot of people don't like to talk about them because they don't move. They move methodically as opposed to a little bit more volatility. And option trading on them is kind of tough. Markets are a little bit wider. When you're trading options and you're looking at underlyings, you kind of want it's kind of an oxymoron, but you want some volatility with some predictability. And I kind of throw Marathon Oil into that range. Now, one of the things about Marathon Oil is that, like, if I just even look at these options that we're talking about, 50% implied volatility is a little bit too high. I would prefer it to be around 30% implied volatility. But I don't care if I'm doing a spread. It doesn't really matter to me as much. The first initial trade that we look back on January 18th, that did scare me a little bit, that implied volatility was high. But if you go deeper in the money and you buy a higher delta, you're buying less time premium. And so the implied volatility fluctuations don't hurt you as much. So both of these trades that we've discussed today address the issues of high implied volatility. If I go deeper into money, I get more intrinsic value. I pay less time value. I'm paying for intrinsic. I'm paying less time. And so the time decay issues, the volatility fluctuations aren't as big of a concerns. So you could look at both of these strategies and say, fear of volatility strategies, because that's what both of these are. Another way to, I guess, phrase this long call spread. All right. A little bit more detail than I planned on going on, but great question nonetheless. Is there a formula for exercising long call options? Okay, so it looks like Vlad. Vlad, if is there a formula? There is. I don't think that it's really appropriate necessarily for public traders of options to think really about exercising your long call because of a formula. But what it really comes down to is that when would you exercise that long call? You might exercise ahead of the dividend if you are deep in the money and there is no time premium. So let's make the math really simple. If you are deep in the money and there is no time premium left in the option contract, means it's all intrinsic value, and you're planning on exercising anyways at expiration, you may exercise early because you want to capture the dividend. And I do have, actually, inside the options playbook, don't go there, I'm going to get there eventually here. Let me, and managing your positions, actually, this will answer your question. What is early exercise and assignment? And okay, now let's show the screen. So right now we're showing what is early exercise and assignment. When might it happen? When might you consider it? And if you read that little few page section, it will highlight all your questions, Vlad. It will answer all your questions in a couple of pages. All right. Do you ever use the RSI and DMI for determining the factors on a stock play of the day? Yes and no. I don't highlight it that much in the charts. I'm looking more so for trend lines, and also talking with our chief market strategist, Lindsay Bell, about different sectors that I want to look at. But I do not, anything that makes you feel more comfortable about a potential trade, I look more so at a trend line, a breakout, moving averages. But RSI is always of interest to me. I just don't always highlight it on the stock play of the day. All right. I think is that any more questions that we have? I think that's it for the day. All right. And we're right at time. So that's it for the stock play of the day. Thank you for all the great questions. Please click subscribe. Please ring the bell. You'll be back this Friday and we'll look at this trade. So there'll be something to look at in the stock play of the day. I love the fact that we got the chance to talk about a FOMO trade and how we would adjust it now that it's doubled in price. So if you're looking at how to, some thoughts on how to adjust positions, stock play of the day overtime is a great thing to join. You click subscribe, you ring the bell. We'll see you this Friday for the stock play of the day overtime. Thanks for coming, everyone.